Joining us now is former Dallas Fed president and Barclays senior advisor, Richard Fisher. Welcome back. Richard, good to see you.
Good morning. Good morning. Good morning, sir.
Why isn't the Fed more worried about what happened with bank failures and the impact that's going to have on the economy and stress in the system? Why doesn't it seem as worried as the market, which is now pricing in rate cuts?
Well, I'm sure they're worried about it, but I don't think they're worried about it being carried away. And by the way, with regard to these past comments just now, if you look at the discount window and the special lending facility, those numbers have ticked up in the last week, but they're not extreme. So it doesn't appear that the system is collapsing. That's important. And yes, banks are tightening, but what it comes down to is a trade-off between fighting inflation and creating additional unemployment at a period where employment's still very strong. And we saw it, by the way, in the global PMI numbers that just came out. There still is inflationary pressure. They're taking pricing, these companies, as far as they can take it. Their inputs are costing a little bit more. And even though labor is more available, it's expensive. So this is the trade-off, and that's what they're going to do. That's what a central bank has to do. There's
just this nagging feeling, though, that maybe inflation is coming down pretty quickly, or at least we're starting to see disinflation. We agree we've seen the peak on inflation, and that the impact of all of these hikes has not fully been felt, and we could see more things breaking like we saw with banks failing, and that the Fed is looking at data that is more backward-looking than forward-looking on the economy and on inflation.
No, look, the Fed has access to every contemporary data point, every survey. Anything the market can look at, the Fed can look at in spades. So you have to be careful here. I mean, look at what happened in the UK. Their inflation came down slightly. It's 10.1%. It's hard to slay this dragon once it gets out. And I do think that's the principal purpose of a central bank. So 5% inflation, 4% inflation, unacceptable. You have to be moving towards the 2% target. That's your job. And at 3.5% unemployment, still more people trying to find people to work than people willing to work, then you have some leeway to run a tight ship. And to be sure, as to your point, the markets are tightening and the banks are being more stingy and not lending as much. It's hurting the commercial real estate sector. It's killing venture capital. Anybody that's providing either loans or some kind of credit or investment to these sectors is pulling in their horns. That's helping, but it doesn't seem to be doing too much too quickly here. And the Fed still has to slay the inflation.
At least not yet.
Yeah. Well, Richard,
right.
What is the best way to measure?
You're right. Go ahead, please.
What is the best way to measure the impact of that credit tightening you reference? Obviously, we can all see it anecdotally or hear about it, I should say, particularly in certain areas that have particular weakness, such as commercial real estate. But how do you measure the impact it's really having?
Well, I'm sure there are plenty of mathematical formulae to do so. I think a lot of it is just a feel. And I want to remind you, and I hope everybody understands this, Fed policy is not driven by mathematical precision. They have every model imaginable, from Furbus, the biggest model of the U.S. economy, to everything else. But they have every data inflow that you can conceivably get, whether it's the traffic patterns given by Waze or any other what I call contemporary data, instant data that you can constantly monitor now thanks to technology and the net. But it comes down to judgment, and it has to be feel. And they're just going to have to sense this as much as possible, looking at what they look at. Things are slowing down. We see it in the freight data. We see it in all kinds of transportation statistics. Everything but restaurants seems to be slowing down. But the question is it slowing down enough to quell the inflation dragon? And so far, it doesn't seem to be doing so.